Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. Been a little cold lately. Yeah, I was wondering when it was going to get to that. It's just so funny. I can remember back when I was in junior high, and they were talking about how we were going into another ice age. We're going to have another ice age, and it wasn't uncommon. In fact, the school district that I lived in, if it didn't snow more than 12 inches in less than 12 hours, we were going to school. Try to do that today. But, it was another day. They just thought, this is the way it's going to be. We're going into potentially another ice age, and everybody was wondering about it. And now looking out at how quickly the weather changes. And, still learning. And even with the stock market, I thought that by this point in time that everybody's going to know what's happening, and jobs like mine are not going to be there. Boy, was I wrong? Yeah, it's changing, and the rate of change is incredibly fast. And so I did not anticipate that. I thought that at some point in time everybody would get it. It'd all be the same. Market volatility would definitely calm down, and instead it's picked up. So that's what you get for thinking. And it's kind of like forecasting the weather. If you really want to know whether it's going to rain or not, just look out the window. Just look out the window, and if it's raining, get a raincoat or an umbrella. Basically, that's kind of what stocks are like. They're going to have good days, they're going to have bad days. So you got to have an umbrella. The umbrella is the amount of money you have in something that's relatively safe. And then the making it through the storms, making it through stocks. It's not really, it all depends on your mindset. It's your age. It's how long have you been exposed to this? An awful lot of people, it just doesn't happen in their lives that they have to really dig deep into see what happens, why it happens. And an awful lot of people just look at the performance, and they're always told this is the mistake that the do-it-yourselfers have a tendency to make. They look at the past 5 and 10 years as if that's all you got to do. Sometimes that works out really well, but when it doesn't, it's normally pretty bad. And I hate seeing that. I just hate seeing that. It's so tough, especially when somebody's been pretty lucky their entire working career, and then they get up to close to retirement, and then they suffer big losses because they were only looking at the returns and not how those returns were being generated. And I'll give you an example. In fact, I'm so excited. This company came out, and I don't get excited about a lot anymore. But there's a company that came out with some funds that they're managing, and they've got when a fund is new like that, I learned when I first left. I thought these funds were going to be here 20 years ago. When I left to form Bullington Capital, I really thought that this was going to advance a whole lot quicker than it did. I mean, there were tons and tons of ETFs, but the ETFs are using formulas that are fairly similar, and they're incredibly aggressive and incredibly volatile. So, and I knew because I built my own models for stock that you could tame the volatility down somewhat. You can't avoid it completely. That's called a CD. But you can monitor the risk. You know how much risk you're taking approximately. Occasionally, you might get surprised, but you can really follow much more closely now. The problem is it's a lot of effort. I mean, it's incredibly difficult to keep up with if you're managing more than 2 or 3 accounts that way. Good luck. And if you've ever tried to do that, you know what I'm talking about. The people that get mad when I say good luck, it's because they've never tried it. And they're going to look back one day if they do try it and go, oh, that's what he was talking about. Yeah, okay. So, but it's not necessary, and it's really not necessary. There are enough funds out there today that look at things like cash flow, which that's relatively new, believe it or not. The vast majority of funds, stock funds in particular, that are available today are looking at the size of the company based on the share price times the number of shares outstanding. That's called market capitalization. Basically, how much is all your stock worth today? You know, if you were to buy it at the price it's selling for right now, and you bought every share, how much would you be paying for the company? And they call that market capitalization. And it gives you something to compare. You can compare sizes of companies. You can actually go a little bit deeper, and that's what the new ETFs are doing. They're looking at how much cash those companies are actually generating. And if you divide the cash by the share price, it turns it into a CD or a yield that you can compare to CDs or other stocks. And so if you had a yield of 5% on one stock and a yield of 2% on the other stock, which one would you normally like? Not a trick question. If you're getting a 5% yield, you should probably take that or at least add it and don't put all the money in the one with the 2% yield because it's got a great story. And lots of stocks have great stories, by the way. I mean, lots of stocks have great stories, but only a handful are actually going to fulfill those stories and go on to become big winners. And again, it's one of the reasons I prefer funds these days. I can concentrate on those areas. To make an adjustment, it's 10 times easier to adjust portfolios because when you get in, you don't just set your money and forget it unless it's a big balanced fund and you don't care and you'll take the middle of the road approach. I don't care if I make the most. I don't want to be last. I'm just going to shoot for the middle. That's fine. If that's what you want to do, that's absolutely fine. And then you really don't, you get a couple good balanced funds and just hang on. If you'd like to try to do a little bit better, then you try to use some of these things. And I think that's interesting. So I'll quit talking about that now. I will tell you this, though. If you want to call, I have some paperwork or some illustrations from this company that came out, and they are literally calculating the cash flows and then dividing those cash flows by what you would pay for the whole company. And they're ranking them, and that's how they're picking the stocks. By the way, there's this guy you might have heard of. His name is Warren Buffett. It's very similar to the approach that he uses to pick all the companies that he owns. It looks at the amount of cash he's going to get back, if he buys that company. And so anyway, rather than going into a bunch of details that are going to bore everybody to sleep before my first commercial break, I'll move on to the next topic. and again, if you hear something, if you'd like me to take a look at your portfolio, and compare it to this, or compare it to the ones that we're running, that's fine. Just hit me up on my website, it's bullingtoncapital.com, and we will try to get back to you as quickly as possible. And anyway, um, I always get a couple calls, about gold, and some people are just they're just enamored with it. They just like the fact that it goes up and down. I'm not real keen on it. I can tell you, gold, the price of gold peaked out in 2011, and it's just now getting higher than it. It's gotten higher than that. One, two, three. This is the fourth time that it's gone higher than the peak level from 2012. And the ETF, by the way, has only been out since 2004. So from 2004, there's an ETF, by the way, that you can invest in gold. I think it's a little easier. Although, because the internal expenses can be high on that kind of thing, I think if you really want to buy gold, just go get a couple bars of gold and put it in a safe deposit box. And if you're really serious about being a serious investor in gold, that's basically what I would that's what I would do. And I'm not, because there are gold mining companies and other companies that are involved in the precious metals industry in the ETFs that we have. So I think it makes up somewhere around 3 or 4% of the total, which is a lot, actually. So I don't really have to, but I get calls a lot. Hey, what do you think of gold? What do you think of gold? Well, here's what I think of gold right now. If you look at a weekly chart of gold, it has formed an almost perfect cup and handle pattern, made famous, or made popular anyway, by William O'Neill. It's pretty wild. It's just now closing. It hasn't closed above the highest high point that it's reached. That was in, let me see what year that. That was August of 2020. But it's extremely close, and it looks like the old cup and handle pattern. The only reason I'm talking about this is I get people asking me about gold all the time, and not as much these days as it used to be, but at least once every other month or so. And I'm just not a big fan, because the stocks that we're holding are all generating cash. I mean, they're literally generating cash. And whether they're paying it out in a dividend or they're reinvesting and putting it in the company treasury to be used for a future project, they're growing the amount of cash that they have on hand. Well, good ones are. And but it's cash. It's something that they can spend. You still have your shares, when they spend. If you spend the cash that you get as a dividend. So those companies that are generating cash, by the way, can afford to pay dividends. And there are a lot of companies who are paying dividends out of the treasury, not from the profits that they're making from their businesses. That's a little dangerous. That's actually a lot dangerous. And it's one of the other reasons I'll tell you, I love the ETF approach, because you're getting a basket of stocks that all have similar characteristics, size, amount of cash they're generating now, what their revenues are. You can look into the description and find out exactly how they're picking the stocks. And I think this is a pretty big improvement. It's a pretty big improvement. It's not going to protect you from the market's normal volatility, which is intense. The normal fluctuation in the stock market is intense, and it's difficult to put up with sometimes. Sometimes the markets go down, and when they're going down, they're almost all moving in the same direction, just at different speeds. Some will actually resist. Some will actually go up when markets are declining. I think winning the lottery is probably on about an even scale with trying to pick those stocks. Yeah, maybe not that. Maybe picking next year's Super Bowl winner this year. That's about the level of difficulty. But if a company's had good growth rate in the past, if it's got good profit margins, if they're paying out profits or reinvesting those profits, and the amount of cash they've got in their financial statements is growing, you put a basket of stocks like that together, hang on to them, and we make adjustments as necessary. That is the greatest thing about this, is there's no human judgment involved. When humans get involved, their opinions start to get involved. And oftentimes your opinions can cost you money, even if you're a professional portfolio manager. And so that's one of the reasons that there are so few funds that can get ahead of the market and stay ahead of it, because there are thousands of highly educated participants in the market making up the market. And to think that you'll always stay ahead is pretty tough, especially with the way that the market's structured. Going to beat the market, probably going to underperform it for a while from time to time. And when I say probably, I actually mean you are going to underperform it for a while from time to time. But that's okay. It's okay. It's just, if you're happy with the returns you're getting, if you're comfortable with all that, that's fine. I just think that there's been a major improvement here. There's another option available for the stock portion, and basically picking stocks based on size, speed, and profitability. That's a big deal. I just heard I got about probably at 45 seconds at this point in time before I got to take a commercial break. This is Bill Bullington. I'm right here on 1420 every weekend from 11 to noon. If you guys would like to call in, it's 216-901-0945, and I will be back right after these messages.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
The straight-talking, hard-working, do-it-right plumbers at Wyatt Works will unclog your drain for only $93.
Or it's free.
What's the catch?
There's never a catch with Wyatt Works. I'd rather starve than do business that way.
We really will break up your clog and get your water flowing again for $93.
Plus, we'll send a camera down the line so you can see exactly what you're dealing with.
Most of the time, clog busting's all you need. Wallakadoodle. Back to your regularly scheduled life with a 12-month no-backup guarantee.
If your drain line needs more, we'll explain all the options, including flexible payments and guaranteed estimates.
And on the off chance clog busting can't get your drain flowing, our service call is free.
You'll still get upfront pricing on solutions to your problem, but with no initial service fee. That's on us.
Either we deliver on our promised clog busting, or it's free.
So don't put up with half solutions or slow or clogged drains.
Call Wyatt Works and
consider it done.
License number 30185.
Wish there was a place to find good, clean, family-safe entertainment? A place with no violence or profanity? Where you can let the kids roam free? That place is the all-new GodTube.com. Watch inspirational videos that'll challenge and motivate. Catch the latest music videos from Christian artists like Jeremy Camp, Hillsong, and Chris Tomlin. And share a laugh with clean comedians like Tim Hawkins, Anita Renfro, and more. All free 24/7 right in your own home at the simple touch of a button. Visit the new GodTube.com. That's GodTube.com.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
Why you ever chose me? There's always been a mystery.
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. feel free to give us a call if you'd like to talk. 216-901-0945 is the station's radio number, or a telephone number, radio number. You can call me in my office at 330-664-0700. If you want to leave a message, I'll try to get back to you. I'm on the road for the next 3 days, but I'll call you. I'll even call you from the road. I don't care. And I do have a caller right now, and I didn't get his name, so I'm just going to introduce him as the caller.
It's Joe.
Hey, Joe, how are you?
I am good. Hey, 2 questions for you. One is, you were just talking about Buffett, and it made me think of this news story that, Jimmy Haslam's pilot gas stations?
Right. Yep.
Those they said on the news about a month ago that Berkshire Hathaway had purchased that stock for the company or something along that line.
Yeah,
I was wondering if that would be a good sign. I'm sorry?
Oh, go ahead. I'm sorry.
I was just going to say, I was wondering if that would be a good sign to actually invest in that, in Pilot, being that Berkshire Hathaway took a stake in it.
Oh, when they announce something like that, 9 out of 10 times, the price has already been, they've already decided on the price that they're going to pay. And hang on, I'll look. I haven't looked at it since it really came out. And shoot, not being listed anymore, huh? So at least not under that symbol. There's very little profit to be made by buying something once the purchase has been announced. It's normally either at or close to the actual price that they're going to get, that they negotiated.
Mm-hmm.
And like 4 out of 5 times. And occasionally there'll be a little bit of money to make there. But if the deal falls through and the price was higher than the price had gone up higher than they had agreed upon, and you could lose some money there. And so I'm not a huge fan of trying to do that. I've watched that way too many times, and it's just gone south more times than I like to remember. Not lately, though. I'll tell you what, the past 10 years, the amount of deals that have gone through has slowed like you wouldn't believe. And I know people say, they're the highest number that we've ever had. Okay, as a percentage of the total available opportunities, there are more opportunities now. And as a percentage, that has slowed down quite a bit. So all this, the activity, firms buying other firms, firms coming public.
Yeah.
Yes, but it's
one of the reasons,
kind of interesting.
Yeah, one of the reasons I asked is because I had success about, 10 or 15 years ago when they bought a share of Burlington Railroad. And so I ended up buying some shares into Burlington, and then they actually purchased it. So it was like, first they just, bought shares, and then later on they actually bought the whole railroad. And I kind of got lucky there. And then they gave me an option to either sell the railroad stock straight out or to purchase into Berkshire Hathaway at the time.
Yeah. Yep. So just out of curiosity, which did you do?
Oh, I ended up just cashing out.
Yeah.
And Berkshire Hathaway's shares were at $72, the B shares. It was $72.
Wow. I know. I remember looking up that stock when I was relatively young in the business. It was early 90s. And, oh, man, it's like the Class B shares they weren't even out. This was like 1993. And, let's see, I'm going to look that up to see what that is. It actually just makes me want to cry. But,
can I ask you one more question regarding dividends?
Sure.
I had been in my investment portfolio. I always hear reinvest the dividends, but I've actually been doing just the opposite. I indicated on my investment in my retirement account to just cash them out. So every time I got a dividend on something, it would just go into my cash account. and I've been doing that for a while now. And I don't know. I'm just wondering if that sounds like a good idea, bad idea, or indifferent.
You know what? That's one of those things where there really is no right answer. If you happen to, I have some shares of Procter and Gamble, and I let the dividends just go to my money market. And would I've made a little bit more money? Yeah, over the time period I've held it, but not a lot. Yeah, because you're only looking at maximum of 2-3% in most cases. But and unfortunately, you won't know the answer to that until it's too late to do anything about it. It could turn out to be the right thing to do, or it could turn out to be you've been better off reinvesting. But it's not going to make a gigantic difference.
Okay.
In 99 out of 100 cases, it's 6 of one or half dozen of another.
Oh.
And yeah. Really depends on the stock. This is funny. I looked up Berkshire Hathaway, and when I was looking at it, I remember it was in 1992. So its price was $8,361 a share.
Mm-hmm.
And I remember thinking, what? Who in the world? It's like, that was a long time ago. I didn't have nearly as much experience to get our quotes, our satellite system, just for the quotes would go down once or twice a day. And anyway, now that it's at 613,000, that's pretty good. Although, all
God.
stocks, this is the 1998. It got up to 83,000, a little over 83,000, and back in in 2009, it actually traded below that level for a couple months, and then it turned around and started going back up, and that's the part that is just with individual stocks. It's the part that's so hard because people in the public will look at someone like me and go, "Well, you're the professional. You should have seen that coming, and you should have gotten us out, and then you should have gotten us back." Well, if I were that good, if Warren Buffett were that good, he would have sold his own stock and then bought it back. And it's just not how it works. And it's always been, it's always bothered me a little bit that people really don't know, and not so much anymore. But it's a lot when you look at the volatilities, the correction that Berkshire Hathaway had from 2008 down. It was down 54%. Down 54%. So if you had purchased that in 2000, and actually last month of 2007, you paid $151,000 for it, right before it goes down to 89, and almost 50%. And it took it until 2013 to get back, which is not that bad actually. That was pretty quick. It was a pretty quick rebound. But that's what's wrong with. Well, it's not wrong. It's just how stocks are. It's always been that way. I tell this story all the time. I read when I first got into this industry that the average range for the average stock on the New York Stock Exchange, which was the biggest, most prestigious exchange in the world at that time, the average range for the average stock was 50% a year. And I was like, what? Nobody didn't tell me that in the Series 7 class. And that was and I'm with. So anyway, and they were right, and it's not really changed all that much, and that's the other part about it is average range for average stock on the New York Stock Exchange 50% a year. That number is still pretty close to that, and it varies a little bit from year to year. But if and Warren Buffett said, "Hey, you can't stand to see the value of your stocks drop by 50% or more. Don't buy stock." And I thought he was kidding. And Peter Lynch said the same stuff, and then everybody else I talked to. The other thing, the one that's really hard to understand is every portfolio manager who's got a long-term track record that's better than the S&P 500 has seen a period of somewhere between 3 and 5 years where they lagged it, where they got beat by it, 3 to 5 years in a row. So it's hard to keep confidence. That's probably the hardest part of my job, is you have to stay confident because market's going to test you, and you can be doing the exact right things, but it looks like you're doing the wrong thing. And
it seems like it tests you a lot.
Yeah. And I guess that's why I like it, though. Yes, yeah, or your lifetime. Yeah, that's interesting. The older people I have that seem to have done the best, they rarely look at their statements. I don't know. I know why now, because now they're all digital. But before, when it was all paper, they didn't. They wouldn't look at them. They put them in a drawer, or a folder, and just keep on keeping on. Just keep adding to their stuff. Today, the kids.
Well, thank you, Bill.
Well, thank you for calling in. Sorry to talk your ear off like that. Didn't mean to do that.
No, that's okay. Thank you. Bye-bye.
Have a good weekend. Yep. Bye. And you can call us 216-901-0945. I promise I won't talk to you that long and bore you to death. But the markets are still volatile, and it kind of goes in with what I wanted to talk about today. There's some new funds out. They're ETFs, and they are looking at the cash the company's actually generating, and then they are trying to get a good deal based on the cash that it's generating. And I think that's a departure from an awful lot of funds and ETFs out there. And the turnover is going to be higher inside the fund when you have a strategy like that. There's going to be more buys and sells, but you don't see that. You just see the share price. And in fact, if you don't sell the fund, you don't have to pay taxes on it. So while all that activity is going on inside the fund, you're not paying taxes on it. That's a big deal. That was one of the major reasons that I looked around. I saw what I was doing, and I was building models very similar to those because I liked them and they didn't exist at the time. And then when they came out and started going down this path, which is probably 15 years ago, they're still not where I think they should be. It didn't come around as fast as I thought it would, but it's here now, and so they're very tax efficient. You got a lot of tax benefits from holding exchange traded funds rather than trying to put the portfolios together yourself. The cost on the funds is extremely low. So even when you're paying a management fee, your total expenses are literally less than half of what they were 20 years ago. So even at the higher end, you're half of what they were. Now that you've got these funds out, I'm really excited about it. It's not like I guess I wouldn't need to shout it from the rooftops, but it is going to make a difference for an awful lot of people, especially when you're looking at some of the smaller funds. In my opinion, they struggle when you're using traditional indexes to calculate which stocks to own that are only looking at the size, and basically that's because of liquidity. I'm getting off on all kinds of tangents here. I apologize about that. But anyway, so if you want more information on what I was just talking about, please feel free. It's Bill at BullingtonCapital.com. I'll send you out some material on it. Actually, I can send you a link to their website. You can read about it. And we're going to start to incorporate that a little at a time. And I always go pretty slow. So, but I do have a couple of funds in mind to substitute some of these funds for. So if you're listening out there and you're a client, I have to go down my entire list. This is one that I'm going to call about. I have discretion on accounts, and we're able to put things in place without having to get a hold of you. And we will do that for an awful lot of my clients. But For an awful lot of them, I'd like to talk to them about it first to say, hey, this is what we're going to do. This is why. You go to this website, or I can email you. You can download the PDFs and take a look at it. But it's a pretty big deal. I'm just shocked, though, that it took this long. I mean, I was like, I thought these things would just start ripping out. Like, we used to get 2 or 3 new funds, whether it was a open-ended mutual fund or a closed-end fund. That would come out. Now we were getting 2 or 3 a week for several years. I mean, decades actually. And all of a sudden now that activity has slowed down pretty significantly. It's not that big a deal, but you just have to get an idea of how to deal with it. I'll come back to stocks near the end of the day because I know I still have people out there who are looking for stocks, and I'm going to explain to you. I don't do this a lot anymore. I'm basically the value-oriented guy. This is what I used to do before they came out with ETFs that were doing things that were so similar that it really didn't make a whole lot of sense to keep doing it. But a lot of people like to do it for the thrill. They just like trading stocks. And if you're going to trade stocks, you should probably look at stocks that are going up right now real fast. And the idea is that you identify. I'm sorry. Yeah, I thought I got interrupted there. You should go with stocks that are going up right now real fast and put a trailing stop loss on it. So if it comes down to a certain level, you're going to get right out of it again. And that's how I would approach this. And I've got about 20 seconds here before I got to take a commercial break. You're listening to Bill Bullington. I'm right here on 1420 every weekend. I'm going to, when I come back, I'm going to talk about some fixed income rates that are pretty high. They just raised them again. So stay tuned, and I will be back shortly.
I've been running in circles, jumping the hurdles, getting caught in that rush of doing so much. I'm feeling kind of worn out. All this checking the boxes, trying to be flawless, has me spinning my head, catching my breath, too afraid to slow it down.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org.
The straight-talking, hard-working, do-it-right plumbers at Wyatt Works will unclog your drain for only $93.
Or it's free.
What's the catch?
There's never a catch with Wyatt Works. I'd rather starve than do business that way.
We really will break up your clog and get your water flowing again for $93.
Plus, we'll send a camera down the line so you can see exactly what you're dealing with.
Most of the time, clog busting's all you need. Wallakadoodle. Back to your regularly scheduled life with a 12-month no-backup guarantee.
If your drain line needs more, we'll explain all the options, including flexible payments and guaranteed estimates.
And on the off chance clog busting can't get your drain flowing, our service call is free.
You'll still get upfront pricing on solutions to your problem, but with no initial service fee. That's on us.
Either we deliver on our promised clog busting, or it's free.
So don't put up with half solutions or slow or clogged drains.
Call Wyatt Works and
consider it done. License number 30185.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit JoyceFactoryDirect.com.
I've heard them say before to live just like you're dying, yeah. Wish I could say that's how I am, but I've been
Well, welcome back. Bill Bullington. Here every Saturday morning from 11 to noon. WHK 1420. If you have any questions, you can always send them to me at my email address, bill@bullingtoncapital.com. And or you can call us 330-664-0700. And I have to tell you, the last, I don't know, it's probably been the last, seems like it's a little over a year. If you're having difficulty signing on to any, like I've got 3 different bank accounts. That's all I have, by the way, including my business. And but I've had problems with all 3 of them, and they're not the same bank. Had some issues with some of the custodians being able to do certain things, and I don't know. I think it's something's going on at a really high level, and nobody's really saying about it because I think they're too afraid. But anyway, just another reason to have a financial advisor, because we'll help you get that set back up. And yeah, that's talk about crazy. And I've had a recommendation from a client to learn how to use this software package. Thank you very much. I'm just kidding. And I am. And it does a lot. And what's really funny is I thought this was, the heavy learning in my career was over. Wrong. But it's interesting. And so we should be able to increase the services that we're providing, and should give you another layer of protection. Because remember, when you get paid as a percentage of the assets, if the assets disappear, you're not getting paid on that anymore. Now, when the assets go up, we get a pay raise. When the assets go down, we get a pay cut. So my income from month to month fluctuates a lot like the stock market. Now, how'd you like to live like that? And I'm used to it, so it's not that big a deal. But I do want to talk, and that's another reason. I've had questions. People are asking me, "Hey, how come you always talk about those annuities?" Well, because annuities offer something that you can't get in the stock market. They have a guaranteed income, and the amount of income that you can get is a lot. It's more than you're going to get in bonds, depending on the age you are. The vast majority of them are more than, by the way, it's all age related. The older you get, the more income they're willing to guarantee, because your life expectancy is getting shorter. Okay, so that's one of those places where being older actually has a big benefit. In fact, let me give you an example. Here's somebody who's 66. They're going to be 67 next year. Going to turn on going to start taking Social Security. They get full Social Security without any penalties, and they're ready to go. Okay, so you put $100,000 in when they're 66. This one in particular, you have to wait 12 months before you turn the income on. So, and if you're already taking income from it, you can just take out a year's income and leave it aside and just keep drawing that. So a year from now, then you turn the income on, and that'll just be deposited into your bank account, and that works out pretty good. Anyway, somebody who was 66, going to be 67 next year, puts $100,000 in. 12 months from now, they turn the income on. It's $7,750. $7,750. That's guaranteed for as long as you live. So if you live for 150 years, if they do find out how to make you live forever, I think the insurance company's going to be upset. But if you lived until you're 100, you would still get that, which is pretty good. I mean, compare it to other sources of income. That's a really good one. If you waited, say, until you were 68, that number goes up to 8,476. That's really good. If you waited until you were 70, at 70, they don't guarantee anymore that your Social Security is going to go up by a certain percentage. Now, it probably will. And by the way, you want to see an entirely new Congress and new Senate, let them cut Social Security. I'm just saying. It's not a political thing. It's a money thing. You cut Social Security, you're going to see an entirely new Congress and a new Senate and a new president. They're all going. That's what I believe. Because you can't mess around with that, and you pay into that for. I started paying into it when I was 18 years old. So I'm not telling you how old I am because it's a little embarrassing. I'm just kidding. But anyway, so it'll go up again, and here's somebody that did it when they were 66. By the time they're age 76, if they waited that long, then the income is $16,896. Now, sometimes when I say that, and by the way, there is a website you can go to. That's where I'm getting this from. If you would like to have me send you the link so that you can go to that website and put your own numbers in there and play around, feel free to hit me up with an email or leave a message for us. And it's a very solid offer, very solid guarantee. I really like it. Yeah, are interest rates going to continue to go up? I don't know. Anybody that tells you that they know that is either delusional, and there are a lot of those people out there. So they're not trying to do anything wrong. It's just what they happen to believe, and or they don't want you to know. There are no other reasons. It's either they're not that bright, or they're hoping that you're not. So one of the two. But anyway, I just you look at what bonds. Oh man, So if you had put a whole ton of money in, say, the bond, any type of bond fund, you put it in back in 2020, and because bond funds were paying a little bit more than CDs were at that point in time, that bond fund is down now 18.2% on average. Now, the average bond fund is down a little, almost 20% from where it was back in 2020. And what year is it now? 2024. And the fund that's in bonds is down over 18%. Now, that's not too good. You've got to be. That's one of the reasons that we still have a job. I took a fund that has a super short duration, and if you were unlucky and invested at the peak in this bond fund, it's down 2.36. I don't know, 18 or 2.3. By the way, the income that it's paid has much more than made that up. And in fact, if you were taking out income from it, you probably wouldn't even really notice too much. 1 or 2% fluctuation is not a lot. I will tell you, when you put bonds in a fund, you've just turned it into a stock. It's a more conservative stock, but it's still a stock. The share prices on a fund fluctuate a whole lot more than the underlying value of the bonds do at times. I mean, there are going to be times when the share price, because it's a fund and people are running for the doors selling everything, then that fund price will drop below the actual value of the underlying bond. And that did happen. And we tried to capture and get people to invest during that time period. That was in those particular types of funds. That was really hard to do because everybody was so afraid. In fact, most people did not do it. And it's unfortunate because that was a good opportunity. Those were super high quality bonds, super short term, high yields relative to everything else that was going on at the time. They still are. So if you get a big drop like that, that's one of those times where you say, okay, I'm going to dig into my cash savings if I have any, and I'm going to add to the shares of that because they are really down, and the chances of them staying down are pretty remote. Okay. So that is one of those areas where if you get the chance to buy low, you should probably do it. And of course, every time is a little bit different. That's what really kills me about financial markets. It's always different. Markets are constantly evolving. They're constantly changing. Just like the product I was talking about earlier today, that basically they're run by computers, but the computers are measuring how much cash the company's generating and making the allocations to the stocks in that fund based on how much cash they're generating, not what the share price is. That's the bone I have to pick with the market cap weighted, which are fine for a lot of areas where they don't have anything else. If that's all you got there, it's still pretty good. It's still really good. But if you've got a choice, look at what the underlying companies are generating as far as cash, and then make your investments based on that. That's what that's doing. Now, if you don't want to worry about any of this stuff, again, now the Nationwide, you're looking at, you put $100,000 in there a year later, you're 66, a year later when you're 67, that's full Social Security age. You're taking out $7,750 to per 100,000. If that were $1 million, it'd be 77,000. And I think I only have one person that's doing that, but it would be $77,000, and that would be guaranteed for the rest of your life. If you didn't want to take it the first year you were eligible, which is a year from the time you sign up for it, it goes up. They'll guarantee $84,076. That's pretty good. It's not $1 million, by the way. On $100,000 is $84,076. So it's a really good. It's the highest guaranteed rate from an A+ rated company that I know of. There may be some others out there down in the future at some point in time, but if you're getting ready to retire now, or you're looking around to kind of settle down and get your plan in place and enjoy the rest of retirement, this is one of the top. So I just got the warning that I've only got about 60 seconds left. If you'd like to see anything you've heard here today, or you'd like to set up a phone meeting, feel free. A couple weeks from now, I'll probably be able to do video calls. Not that I like to do it, but it'll be another option. And anyway, have a good week, everybody. This is Bill Bullington right here on 1420 every weekend, 11 to noon. I will talk to you again next Saturday.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.